Well, let's get straight to our market chat then. We have a guest with us in the studio. Sanjeev Prasad, the Managing Director and Co-Head at Kotak Institutional, joins us in the studio. Hi, Sanjeev. Good to have you in person in the studio. What brings you to Mumbai?
Just work. I'm employed half in India also.
All right.
Half in Singapore, half in India.
How are you feeling about the markets though, Sanjeev? You know, off late you've been putting out those cautionary notes. You've been telling us on a time-to-time basis there's a bubble in various sectors as well. I believe that you're working with modest returns, in the next 12 to 18 months. Define modest. What would it be? High single digit?
Yeah, 5 to 10%, I would think. In the last 1 month or so, I think become slightly more positive, I would say. Neutral to positive compared to fairly negative stance which we had a year back.
Yeah.
And the reasons for that is pretty simple. At least now we are starting to look like earnings seem to be stabilizing after a period of very heavy downgrades in the last 12-15 months. And second is 27 looks like a decent year for earnings growth.
Okay.
In fact, we're now looking at about 17% growth for Nifty 50 profits.
17?
17, yeah. Okay. Compared to about slightly below 10 for the current year. See, the whole problem last year has been you had high valuations and a series of earning downgrades. If I remember correctly, same time last year we're looking at about 1250 rupees EPS for the Nifty 50. That has come down to about 1090 now. So that's been the big problem. This time around looks like earnings are stabilizing and 27 could be a good year for earnings.
So you think we're towards the end of that earnings downgrade cycle, and for this year we should work with 8-9% and mid-teens for 27?
Looks like, yeah. So I think we are definitely coming to the end of the earnings downgrade cycle. See, last year earning downgrades were led by, or I should say rather the current year, in the last FY 2026, in the last 12 months, you had earning downgrades coming from autos, banks, and IT sector. This time around, auto should do a lot better simply because of the GST rate cut. And hopefully, we don't know when the 8 pay commission gets implemented, but if it gets implemented towards the end of FY 2027, you could see some bump towards the end of FY 2027 also. Banks should see a decent turnaround from a decline in profits in the current year to decent growth next year. Simply because all the negative factors of weak loan growth, decline in NIMs, and also higher credit costs should all reduce going forward. And IT, we know it's been a very challenging year, the current year. Hopefully things look better next year.
Sanjeev, hi, morning, Rima here. You've always been concerned about the valuations in the Indian market. You've been calling it out. Since we've gone through about a 12-15 month period of time-wise correction, how are the valuations now, and which are the pockets where you still think valuations are excessive? Where are the valuations moderate? And where, if you do see value in any pocket of the market, where would that be?
The valuation challenge still remains. The problem has been that valuations have stayed high through this period simply because you're earning downgrades.
Correct.
It's not as if we have seen multiples coming down. What has happened is prices have come down, but on the back of earnings coming down. So more or less valuations have stayed high. And that challenge remains. Having said that, at least one part of the negative, if I may say so, of earning downgrade, that seems to be out of the equation for now. So now coming to valuations across sectors, see, most of the consumption names are still very expensive. Especially if you look at consumer staples, parts of discretionary, it's very hard to argue for 45 to 60 P.
Right.
When most companies delivering mid-single digit kind of earnings growth. Even that has been a struggle for many companies in the last 2 years. What resulted in a massive rating in the multiples of the stocks in the last decade was simply very strong secular growth for an extended period of time. If you look at, I'll give you a few numbers. Asian Paints last decade, earnings CAGR was 12%, Lever was 13%. None of this company delivering in numbers anywhere close to that. And because of that, multiples went from, let's say, about 25 P roughly, the beginning of last decade, to about 50 P by the end of last decade. The problem is multiples have stayed high, but earning numbers have simply collapsed. And my worry is that going forward, for many of the consumer names, simply given the fragmentation in the market, the volume growth gets split across more number of players, and also profitability could come under pressure. So it just becomes very hard to argue for high multiples in the construct which we're looking at of lower growth and maybe some pressure on profitability.
So consumer staples, discretionary, still expensive?
Yes, still expensive. IT also, I still think, on the higher side.
Okay.
It all depends on what growth they can deliver. And also keep in mind the fact that in the medium term, you have AI-related issues also coming up. Good, bad, ugly, only time will tell, but it is a big uncertain for the time being. Yeah.
So we got to ask you a little about the sectors of the future right now, because you're talking about names like Asian Paints, etc., all the FMCG staples. The last decade or so, the growth had been led by penetration, more awareness, and probably more money in the hands of people. So that sort of headroom has been more or less satisfied. Now, there are a lot of these sunrise sectors as well, where the visibility of growth, say 10 to 12% sort of earnings over the next 5 to 6 years, irrespective of the valuations, is still there. What sectors, according to you, would those be, and are there any opportunities here?
No, anything to do with manufacturing is in a very decent spot. In the next 10, 15 years, assuming India plays its cards well, you will see a big domestic import substitution story playing out. And government is rightly focused on that. There are a lot of incentives being available through PLI scheme, a lot of focus over there. So I think the manufacturing sector will grow dramatically in the next decade or so. Of course, you have to contend with the fact that Dixon is now at 70 PE plus. But the opportunity set is humongous for many of these companies. Anything to do with electronic manufacturing services, anything to do with electricity chain, there will be massive electrification of the economy. So all the capital companies, companies who make transformers, rectifiers, again will see massive growth. Storage solutions, batteries, etc., again will see huge amount of growth. So not as if there is dearth of opportunities. New sectors will emerge. So you see, some of the challenge for India is that some of the new themes which are emerging globally, and I would put AI, biotech, and robotics, India does not have any great companies over there.
We do have our own, unique solutions for the Indian market, the consumer market, which is via names like Urban Company, Eternal, Quick Commerce, which hasn't done well globally, but is very India-specific out here. So do you think there are opportunities here?
I mean, yeah, these companies are doing amazingly well. You have a very large unorganized sector,
Exactly.
When it comes to retailing in India. So that's a huge opportunity. Healthcare services, another massive opportunity, I would say. Simply given the fact that as India becomes richer, the penetration of healthcare services will increase dramatically, and the quality of healthcare service in general is still very, very, I would say, poor for most of the Indian population.
I think healthcare, diagnostics, those are sectors you like as well as pharma,
very
right?
positive, yeah.
All right. Let me talk about the IPO market.
Yeah.
That got a little bit too hot, too bubbly for some, but not for the ones that got that LG Electronics. Those that got allocated, they would be happy. 50% pop-up always feels good ahead of Diwali, whatever, whichever way you want to slice or dice it. What is your view on an IPO like LG and also the IPO market? The problem is there is more supply coming. But the good news is that at least you're aware now that there is the supply coming out there, and maybe a couple of large ones like Tata Capital, LG, at least they got digested.
See, the interesting thing is, and I will give some numbers over here, if you look at FPIs as an example, they have sold about $23 billion in the secondary market.
But they bought $5 billion in the
$5 billion in the
primary.
So it tells you a story that maybe the IPOs which are coming, A, the stories are good, and B, they're coming at the right price, at least some of them. You gave the example of LG Electronics. If I remember correctly, it's about 35 times money forward. If you look at Havells as an example, many of these companies are trading at 50, 55 kind of P. So if you come at a decent price, attractive valuations, there should be interest logically, right? Because you have benchmarks in the market which are very well established. If you come at a 30%, 40% discount, why wouldn't people want to participate in that? And you have seen a very decent pop over there. The problem is most of the other IPOs, in many cases, are coming at very high valuations. Maybe the public market valuation is high, and then for whatever reasons, companies try and extract the maximum out there. And that's when the problem happens. If you look at many of the smaller IPOs, mid-sized, smaller IPOs, they have done rather badly in the last, I would say, 3-4 months.
You speak about that, the IPO that is opening today, Midwest, it is a mining quartz-related granite company. We're looking at some numbers out there. For a 450 crore issue size, they're charging 20 times EV to EBITDA 1 year forward for a mining granite company. So it'll be very interesting to see how demand and growth comes out there.
But even Tata Capital, right? I know it wasn't cheap to begin with, but they still priced it lower than the rights issue, which was done recently in terms of the large issues. Sitting in Singapore, we were talking about the FIs selling in India. What is your feedback? I mean, is this disenchantment towards India changing now that earnings growth is picking up? I mean, when you speak to all these fund managers, what is your feedback and what does it tell you?
So I would say last 12 months they have been neutral to negative. This is across Asia, Europe, UK, US. I mean, pretty universal, I would say. 1 in 10 you would have found person who was positive. And the reason is very simple. Markets were looking expensive, and people were concerned, rightly so, as it turned out, on earnings downgrade cycle. I think people have become slightly moving towards the neutral zone, but I don't think people are super gung-ho in India as yet, I would say. The valuation problem still remains. Valuation is still high. I see at this point in time, enough opportunities elsewhere, right? We have seen other markets performing amazingly well.
Right.
And despite that, multiples are still far lower, let's say, in China, South Korea, etc., compared to where India is. If you look at some of the numbers over here, if I remember correctly, last 1 year, India MSCI index is down 7% dollar terms. MSCI EM index is up about 17.
Yeah,
MSCI
25% underperformance.
Yeah, global developed market index is up about 14-15%.
Yeah.
So naturally, people are inclined to obviously look at market which have done well more favorably.
Yeah.
Valuations were cheap, and they still remain quite okay. So that's number one. Number two is the fact that you have a lot of companies, especially in Asia, which play on all the right themes or the emerging themes, which is AI, biotech, robotics, as I mentioned earlier. I mean, obviously, you have leading companies in China, South Korea, etc., Taiwan. A lot of excitement over there. And India, unfortunately, does not have any play as yet over there. So those are the two issues, I would think, which have been holding back.
The second one doesn't change, right?
Unfortunately, yes. So the first one has to change, in my view, which means multiples have to, come off. So hopefully we go through some more time correction, a little bit of price correction, and hopefully
growth picks up, so that should.
How will the multiples come off? Because, the kind of strong domestic liquidity that there is, every sort of FII selling that you've been pointing out, has been easily absorbed. So it's most likely to be time correction.
Looks like. See,
are there any immediate triggers for a big spurt in growth or EPS apart from the GST thing that happened, and how much could that, according to you, add to the EPS?
See, but that's already discounted, by the way.
Okay.
The fact that most analysts have already assumed increase in EPS. If you look at for the auto sector, for example, we are looking at almost 20% growth in earnings in the FY 2027 compared to, I think, 4 or 5% in the current year. I'm talking about Nifty 50 companies. Yeah, so that's already built in and discounting in the 1 year forward multiples. So you're right in the sense, the multiples will probably stay where they are, simply because you have a lot of domestic support out there. And you look at the numbers again, DIIs have bought about $68 billion calendar year to date. Yeah. Foreigners have sold about 23, which means another $45 billion has been sold by somebody else. And who is that somebody else? Basically, it's the PE guys and the promoters. Yeah. So between $23 billion of FPIs, 45 of PE promoters, against that you have 68 being bought by retail. So, I don't know the reasons for their optimism, but I would assume that they have made a decent amount of money in the last 3-5 years. Experience has been very good. And despite the non-performance in the last 1 year, people are still looking at the last 3 years' performance and taking a call that, okay, fine, you can still make money in the market from here on.
Okay, all right, Sanjeev, we're just going to address some news flashes on the screen. They're going to come back to you. You said you like select private sector banks, so we'll just address that in a bit.
Sanjeev, on the banking space, do you think something like this is a special situations opportunity for people to consider, given the sort of price move that has already taken place, and now that we understand that it may not be at a significant premium to, what the current price is?
I can't specifically comment on RBL Bank because we don't cover the stock, so I don't have much of a handle on the valuations.
The banking space, as per you?
The banking space has been one of our favorite sectors for a while now.
For everyone, yeah.
Exactly.
I think from the PSUs you like banks, but otherwise the defense and railway names?
Defense maybe still okay. Railways is like, what kind of value?
But defense is okay now, I'm enthused. Tell us, do you think that price correction, time correction?
At least defense, there is a theme.
Yeah.
India requires defense, and there will be a lot of spending be done by the government in terms of procurement of arms equipment for a long period of time.
Right.
But railways, if you look at the numbers over here, the government spending itself has plateaued now.
Yeah.
It was 2.4 trillion rupees in FY 2024, 12.5 in 2025, 2.5 in 2026. And the kind of multiples many of the railway companies are trading at for maybe not much increase in the government spending and revenues in turn, how do you justify the multiples? That's the whole issue over here.
So, other than railways, which is the theme, the narrative, which makes absolutely no sense to you?
Oh my God, you're putting me into trouble now. Some of the electrification themes.
Okay. Why?
Companies, for example, something like a BHEL. Okay. 80,000 crores market cap. very, very hard to justify in the context of the potential opportunity out there. I mean, you can do a simple math over there, right? Let's see if I can get this math right. I mean, India is supposed to add about 80 gigawatts of coal-based thermal capacity next, 5-7 years. And after that, anyway, I think we will move to renewables. I don't think we're going to be adding, coal-based thermal capacity in perpetuity. You take roughly 60 billion rupees per gigawatt, yeah. So 80 into 60, you become about 4.8 trillion rupees for like 80,000 crores. You take a PAT margin of, let's say, even 10%, which is very, very high, by the way. Normally you get a EBITDA margin of 10%. Even then you will come to 48,000 crores of total PAT opportunity. For assuming 100% of the opportunity goes to BHEL, by the way. Now, remember, this PAT will come over the next 10 years. It will take, all this 80 gigawatt will take 10 years to get built. So if we discount that 48,000 crores of potential PAT opportunity, that will shrink to maybe half of that, right?
Yes.
So how do you justify 80,000 crores market cap? There's no terminal value in that business.
Good.
How do you remember these? Yeah, how do you... And BHEL, any others, before we run out of time?
Some of the PSUs like ITI, etc. I mean, I don't even know what business they are doing currently, but look at the market cap of these companies. Impossible to justify. The middle company, I don't remember the numbers now.
The more mainstream companies like ITI not...
Yeah, I mean, then it is okay,
Or you're not saying it because you don't want to get into trouble?
I'm already in enough trouble with that.
just one final question before we let you go. And this is not to do with the equity markets. The other FOMO that is taking place right now is in gold, gold and silver. Where do you stand on that?
We have written a note on this, actually. So we have this funny situation in the world. Let me just digress a little bit. You have all safe haven assets going up. Gold has been going up like crazy, right? At the same time, you have all risky assets also going up, including crypto. And I don't know whether they want to put AI stocks at these levels into that bucket, but that's what is going on in the world. So it just tells me there's complete FOMO in the world. So whatever is going up, irrespective of any logic, people are running after that. Now, gold, if you look at the explanations, and we have a lot of data in that report, lots of explanations have been given, including buying by central banks, etc. But that's not the case. If you look at the numbers for the current year, central banks have bought about, if I remember correctly, about 170, 180 tons, versus about 350 tons, which they normally buy in any year. And this is for the first 8 months, by the way. So in fact, they're running at the run rate below the historical run rate in terms of buying. And if you look at the data, the jewelry numbers are about 2,000 tons. So that is not. No change over there. If you look at the investment part, that has gone to about 1,000 tons for the first 6 months, compared to about 1,000, 1,100 in all the previous years. So that gives you the answer. Entirely driven by investment flows as far as,
I think the gold ETF holding as well is lower today in comparison to what it was 3 years ago. If I remember correctly, it's around 3,800 tons, 3,850 tons, the gold ETF global. And it was around 4,000 tons when gold was around $2,100.
It was small negative. This year is about 350 tons. I'm just trying to remember all the numbers. It's there in the
overall holding.
Yeah. So it's a big change in the investment activity as far as gold is concerned.
Great chatting with you. Thank you very much for coming down. Look forward to more such conversations with you.
Yeah, we can put you in a lot more trouble when you're here as against when you're on.
But actually today, Sanjeev is sounding a little bit more optimistic. Yes. Modest returns is what we could brace for. At least high single-digit earnings growth for this year and mid-teens. Sanjeev, I think you're in fine form today.
Thank you so much. Much appreciated.
Thanks a lot for joining in.
My pleasure.
Well,